Let's jump right into this explainer. Today we're dissecting a fascinating expert report that looks at the exact mathematical tipping point where switching to an S corporation stops being just a good idea and becomes an absolute financial necessity. We're going to treat your business structure like an engine today. We'll look right under the hood at the precise tax mechanics that are either accelerating your wealth creation or, honestly, quietly draining your capital without you even realizing it.
To break this down, we'll walk through 6 core areas. We've got the simplicity trap, tax mechanics, the shield, calculating the threshold, compliance and operational costs, and we'll wrap up with strategic implementation.
Okay, part 1, the simplicity trap.
So, to really establish our baseline here, we need to examine the structural flaws that are baked right into default business entities. You know, when you're first set up a sole proprietorship or a default single-member LLC, you're operating what is known as a pass-through entity. And look, it's fast, it's practically free, and it's familiar. The profits just pass directly onto your personal tax return. But here is the catch. There's this implicit, non-obvious assumption a lot of new business owners make. They think that just leaving money sitting inside the business bank account somehow delays the taxes on it. Well, let me be crystal clear about this. It absolutely does not. You see, the IRS taxes the net profit of the business, regardless of whether you actually withdraw a single penny for yourself.
And staying in this default structure brings some serious implicit risks. Without a formal, optimized setup, you're actually facing a significantly elevated statistical probability of being audited. Why is that? Well, default structures inherently blur the lines between business and personal funds. It's just a reality of how they function. On top of that, you are highly vulnerable to a massive double tax hit on literally every dollar of profit you generate. So that early simplicity you enjoyed on day one, it quickly turns into a massive financial liability as your revenue scales up.
Moving into part 2, self-employment tax mechanics.
Let's completely deconstruct the exact cause and effect relationship of the taxation engine that actively penalizes these default setups. The financial analysis points out that default structures are hit with a flat 15.3% self-employment tax. And remember, this is entirely separate from your standard income tax. Because you're a default business owner, the government views you as both the employee and the employer. So you end up bearing the full burden of Social Security and Medicare obligations, which combine to create this pretty hefty 15.3% penalty.
But here is a really crucial non-obvious detail. This 15.5% tax is actually not applied to your total top-line revenue. Instead, it's applied to a fixed taxable base of exactly 92.35% of your net earnings. Understanding this exact percentage is totally key to diagnosing the financial leakage happening inside a default LLC structure. Let's put some real numbers to this to see the impact. Looking at the data, let's just focus on that $100,000 net profit mark. An operation yielding $100,000 in net profit is basically hemorrhaging over $14,000 strictly to self-employment taxes. And keep in mind, that is long before federal and state income taxes are even factored into the equation. This double tax hit creates a sort of tax treadmill. Scaling your business under this structure simply means you're handing over a progressively larger and larger share of your hard-earned capital.
Right? Let's look at part 3, the S Corporation shield.
So how do we fix this? Let's transition into structural optimization through an S corporation election. The fundamental mechanical difference here is all about how your income is classified by the IRS. As we saw, a default LLC subjects all of your net income to that 15.3% self-employment tax. But when you make an S corporation election, it functionally splits your income into 2 distinct categories: a W-2 salary and passive distributions.
Now, the critical analytical concept here is what the IRS calls reasonable compensation. The rules dictate that S Corp owners have to pay themselves a reasonable W-2 salary based on their specific industry and their role within the company. As a general rule of thumb for our analysis, Allocating no less than 30% of your profit as a salary usually safely satisfies that regulatory scrutiny. By doing this, you are only subjecting that 30% to the self-employment tax. That effectively shields the remaining 70% as distributions, which are completely exempt from that 15.3% drain.
Let's compare the exact same business making the exact same amount of money, maintaining that identical $100,000 net income. If we compare these two structures side by side, we see a massive shift. By simply reclassifying $70,000 of that profit as distributions, your total self-employment tax paid plummets to just $4,590. That is an immediate structural savings of over $9,500 every single year, purely through optimizing your classification.
Moving on to part 4, calculating the threshold. Now, we have to be realistic here. This mechanism is not universally beneficial for every single business on day one. We need to pinpoint the precise mathematical tipping point where making this transition is actually justified. According to the analytical data, $50,000 in consistent annual net profit is your actionable threshold. Below $50,000, the tax savings simply aren't large enough to offset the added costs of running a formal corporation. But the moment you cross that $50,000 baseline, the math flips. The tax savings mathematically eclipse the administrative friction of the corporate structure, making the S Corp highly lucrative.
There's a principle mentioned in the report that I absolutely love. The tax code doesn't reward simplicity, it rewards structure. This highlights a profound, non-obvious reality about wealth building. The default assumption for most of us is that easy and simple is always best. But in the world of business taxation, failing to proactively optimize your structure actively penalizes your financial growth. You really have to view the tax code as an incentive system, and it is explicitly designed to reward those who leverage proper legal structuring. Which brings us to part 5, compliance and operational costs. To maintain strict analytical objectivity, we have to weigh those structural savings against the administrative friction. Transitioning means you're taking on specialized tax preparation, dedicated payroll software, and recurring state franchise fees. Generally, you're looking at a baseline cost ranging from $3,000 to roughly $4,000 annually. That is the hurdle you must overcome. But think back to our math. If your S Corp saves you $9,500 in taxes, but it costs $3,800 a year to run, well, you are still generating a massive net positive yield.
That said, maintaining this corporate shield demands a complete operational and, frankly, behavioral shift. You absolutely can no longer rely on a casual, commingled finance setup. It requires a strict separation of your personal and business banking. You'll have specialized dual tax filings and the mandatory execution of that W-2 payroll. This is critical. If you mismanage this, or if you fail to actually pay yourself that W-2 salary, you risk forfeiting your S Corp status entirely and losing the shield.
Finally, part 6, strategic implementation.
Let's outline the precise execution mechanics required to actually implement this optimization. The order of operations here is entirely non-negotiable. First, you must establish the legal entity with the state. Second, you have to acquire a distinct federal employer identification number, or EIN. Third, you formally elect the S Corp tax status with the IRS. And fourth, you must implement a compliant W-2 payroll system. You literally must do all of this before you take a single distribution from the business. Otherwise, the whole structure collapses. And the entire mechanism of this election relies heavily on timing. You have to file IRS Form 2053 within 75 days of forming the LLC, or by March 15th of the current tax year to have it apply for that specific year. If you miss this highly specific federal deadline, it completely negates the tax shield for the current year, which leaves you stuck in that expensive simplicity trap for another full 12 months. So as we wrap up this explainer, I want to leave you with a challenge. Audit your own financial mechanics based on the metrics we just walked through. Look hard at your net profit. Look at that 15.3% self-employment drain, because simply relying on default assumptions, at leaving your structure unoptimized is, without a doubt, the most expensive decision you can make as a business owner. Crunch the data, figure out if you've crossed that threshold, and build your structural shield.